Good afternoon, I'm Brent Wilsey. My name is Chase Wilsey. We're from Wilsey Asset Management. And welcome to today's Smart Investing Daily Briefing. Well, today there's been talk about a financial transaction tax. And this is coming up more because Hillary Clinton in 2015 said she didn't support it. Now she's kind of changed on that, saying, well, yes, I do support it. So in the political news right now, so we thought we'd cover this to understand what it is. And what it is, it's a tax on each buy and sell you do of stocks and even bonds, which includes your capital gains. So you're still gonna pay capital gains tax to the state and the federal, and you could pay a transaction tax on top of that.
That's pretty interesting, and I think this is kind of because of the rise of Bernie Sanders. A lot of people supported Bernie Sanders, and Hillary seemed to kind of move more of her ideas left, and Sanders actually came out and said, we should tax it at 0.5%. That's the financial transaction tax. He said it should be 0.5%. So that's $5 for every $1,000. That may not sound like a lot, but over time that's going to add up, which is kind of terrifying if you are an investor. And also, the reason that we are not traders is because we don't believe in it, but what it does do is it provides liquidity in the market. So when we want to go out and sell or buy, we're able to go do that because traders are providing that liquidity.
Right, exactly. And one thing too is that in the United States, we had this transaction tax back from 1914 to 1964. They dropped it because it didn't generate much revenue at all, and it did not stop. Even then, they had trading. It didn't destroy that at all. It's still, that's why they dropped it.
Yeah, we've also seen in other countries. Sweden tried it from 1994 to 1991, and also Germany abolished theirs in 1991. Both of them because trading actually moved offshore.
Yeah, if you do strange things, it's going to move away from you. So that's the financial transaction tax. You're going to hear more about it, so we thought we'd clarify that for you. Today we're talking about a company called SodaStream, and I want to point this out because another high flyer. We see these today with a lot of companies. People say, oh, it's great. Well, you can see back in about 2011 came up, a high IPO, dropped immediately, went back up to about $70 a share, dropped again, and now around $23 a share. We keep telling you, don't buy into these hypes. And this from here to here is probably a year and a half or so. So it does last for a while. Don't be sucked in the hype. Let's see if now SodaStream is a buy. Unfortunately, not looking too good here. Sales down 12.5%, earnings down 26.4%. Oh my gosh, the PE, the price earnings ratio, 41.9, average 29, and price to tangible book, 1.7. So not looking too good here so far.
Yeah, and the balance sheet looks okay at first glance. As you can see, current ratio 3.07, quick ratio 1.64. So they do have a lot of liquidity. But again, I do not like to see this big of a discrepancy, especially for a soda maker, the SodaStream. That's way too much inventory on the balance sheet, in my opinion. Those SodaStreams are becoming less valuable the longer they sit in the warehouse. Debt to equity looks good at 9.4%. Now getting our target sell price going out to December 2017. Estimated earnings per share on a GAAP basis, $1. Easiest calculation I've had to do in quite some time. As you see, $16.50 is the target sell price. So still not a buy.
It's not a buy, and I like the concept of the company, but again, don't overpay for companies. This is down around $11 a share. Then it probably made sense, but not now. So, well, I hope you enjoyed this edition of the Smart Investing Daily Briefing. If you'd like to get a free report on the 5 big mistakes that investors make,
give us a call at the office. Our phone number is 858-546-4306. And if you've missed any previous Smart Investing Daily Briefings, go to our website, smartinvesting2000.com.